Good morning, ladies and gentlemen. And here we are at middle of February, and the scores are definitely positive. We have a new high in the on the wrist dial. Now, what is important to remember with the wrist dial is that it measures the scores of the spreads. It does not measure the scores of the SPY. And that is important. Why? Because if SPY is making new highs and the scores are making new highs, it is basically confirming the trend of the price. You will see here that last week we made a new high score of 62 on the dailies ever since we basically started in the positive trend, which was sometime in November. All these scores, well, actually there was a 66 back in December, but that is not really important. What is important is that the direction is the same. And as you can see, this is definitely an uptrend in the score price. If you look at the weeklies, much the same thing. You will see that we closed the week with a score of 59, and we had some 58s in December where we closed, but basically that is the best score since we started the uptrend back in 2019. So if you keep on looking at all these scores, you don't get anything better than the one we have at the moment. And basically that is confirming the trend. The trend is upwards. The trend is your friend. Are we getting rich? Is the market getting rich? Yes, it is. It's up to nearly 19 times forward earnings. But the slope of the Blue Angels is now positive. The market has led it, and there is nothing wrong with this. How high can it go? Well, in early 2000 we were easily well above 20. So, can we go up to 3600? Yes, we can. There is absolutely nothing to stop us. And I keep on saying this, while bonds are in, at worst, a sideways trading range, and they are not going up in yield, these multiples can keep on expanding. Will the market find resistance at times 19? Yes, but you saw how the market found support at times 18. So there is, we have broken out. I don't think we will see the times 17 Blue Angel for a long time. And what do I mean by a long time? I mean months and months and months. While bonds are stuck in a tight range, they are supporting multiple expansion, and the multiple expansion can get really silly. Deviations keeps on catching it beautifully. This is definitely a bull market. It's a market with expansion of multiples, so you don't need a profit rally for higher prices to materialize. You can see how the market stops beautifully at the red line and, just basically corrects in time. This is a buy the dip market. While certain sectors like XLU keep on going up exponentially, you will not see a sustained dip in multiples, and therefore you will not see a sustained dip in SPY prices. Just keep away from the sectors that get ridiculous at the time they get ridiculous, like here at XLK, but you buy the dip. XLK for me now can keep on going. There is absolutely nothing to stop it. It technically did everything right. It consolidated, it broke out, and it's below the red line. As long as its uptrend is reasonable and it doesn't start spiking in the red, there is absolutely no reason to take profit. Just keep on going with it. On to bonds, which I emphasize are the most important sector. While they are not in an uptrend in terms of yield, while they are consolidating sideways or yields are going lower, I just cannot see how you have a sustained dip in SPY. I've explained to you why multiples will keep on expanding. And do we see any signs in anything that we look at in terms of the yield curve or the absolute level of yield to indicate that we are about to get a change in trend in bonds? And my answer to that is no. We are basically we have two ranges in the 2-year note. We have the 150 to 168, which is the neutral range, i.e. people are saying Fed funds are 1.5, 1.75. That's where they're ranging, and therefore the 2-year will trade on top of it. And then we have the area where they say, oh my god, the Fed could ease, so we go back below 150 and we stay between 150 and 137. If that range is broken at any stage, you will get basically a move down to these levels, 115, where people are saying the Fed will definitely ease. Well, at the moment, with SPY doing what it is, with risk doing what it is, people are saying we're trading in the 151 to 137 range, and that is quite reasonable. So there is absolutely no reason to not buy a dip in SPY, because that is what the market is telling you you should do. Is the yield curve telling us anything? Well, this is the 2-year, 10-year, and to me the bull-bear line is this yield of around 13 to 14 basis points. If we start seeing closes below 13 to 14 basis points, especially on a weekly basis, then the market is saying the Fed will ease at some stage. And the Fed would ease why? The Fed would ease because maybe the economy is doing badly or sheer weight of money. But to me, what this will say is that XLF will have a difficult time, and if XLF has a difficult time, then in general SPY has a very difficult time rallying hard. It can, it just can expand a little bit, but rally hard it can't. So to me, while we are above 13 basis points in the 2s, 10s, the SPY can keep on going full blazes ahead in everything. If XLF and even XLI are having difficulties, then really what are we looking for? We're looking for, sort of 0.5% here, 0.5% there, but we're not looking for the sustained 1, 2, 3% rallies in SPY that we can get while the 2s, 10s is above 13. Are we seeing any signs of danger in anything in 5s, 10s, 30s? No, I'm afraid we're not. We picked this level, months ago? 177 in the 5s. Do we show any sign of going through it? No. Range is 177 down to 117. That is your range, and you play it, and you play it hard, and you play it for a long time. If we look at the 10s, we are seeing very much the same kind of picture. I think it's going to be very hard for the market to break through down through 140. If we start breaking down through 140 on a closing basis, then something is wrong. And this area around the 199, 2% is going to be very, very difficult to break as well. So as you can see how many times we have actually traded this range, you can see this breakdown here, you can see this breakdown here, you can just keep on going backwards and seeing how many times it's broken. But what is, to me, this multiple expansion is coming from the fact that we just cannot sustain high yields in bonds. And that is telling people that it doesn't really matter what they pay in SPY, because multiple expansion eventually will get them out of trouble. And that is the that is what the market is telling you. Higher yields are never sustained, and if they're not sustained for a long time, then the risk-on factor comes back in, and people start buying because they want yield. And if they can't get in the bond market, they're going to get it in equities. If we look at the 30-year, I mean, to me, it's quite clear that TLT just cannot break down. You can see how it just stays in a very nicely wide range unless we start going through this level, which is 137 on the downside. To me, 137 on the downside is extremely important. Unless we start going through there, the market in risk is fine. It is, it's a buy the dip market. I know that I'm getting very boring and repetitive, but now bonds and equities are tied at the hip because multiple expansion will keep on going on and will get sillier and sillier until the bond market breaks it. Are we seeing any warning signs in the bond markets in Europe? Well, absolutely not. Volatility here is dead and dying. We drew these lines a long time ago at minus 48. We said this was wonderful risk reward for a move back down to 61. We got it. Since then, we've done absolutely nothing. I can argue now that in times of panic, the best we will see is minus 71 in terms of yield, and the worst we're going to get for the foreseeable future is minus 48. So we are in a 20 basis points range there, and if we look at the Bund, we can see that really, to me, the worst we're going to see is minus 22 for some time, and the best possibly minus 60. So that is really your range for the foreseeable future in the bond market in Europe. Now, if that is the situation and the market is accepting that the likelihood of seeing positive yields in Europe is very, very slight, then what do? I guess that if you're a European asset manager, you flee bonds and you are forced into going up the risk curve into equities. And that is, again, what is supporting the equity markets worldwide. It's, I think, as simple as that. It's the only explanation which makes sense, and some people are fleeing Europe, selling euros, buying dollars, unhedged, and buying the equity markets in the States. You really don't need to make it any more complicated than that. Yield differentials between the States and Europe are absolutely stuck. You can see that we've been trading around the 200 to 195, a 5 basis point range for such a long time, basically since the beginning of 2020. And that is not supportive of the euro, it seems, although this whole move here was not supportive of the euro, so basically sideways continuation is not going to be supportive of the euro. It seems to me that people are basically fleeing the uncertainty of Europe, because even if with this coronavirus thing, Europe is going to be more affected than the States, and therefore people are just not taking a risk. They're fleeing the lower yield, the lower growth, and basically just, I think, just buying US equities. That it's really as simple as that. I cannot see that if this whole move from minus 280 to 200 has not been supportive of the euro, I don't see how 5-10 ticks up is going to be supportive of the euro. It seems to me that the euro is now on a one-way street, even though it has natural corrections along the way. I've been wrong about the dollar. The dollar is in trend now, I would argue. This is a bear flag of many, many weeks. This is a weekly chart, don't forget. I think we are now going up. Really as simple as that, and that should actually slow down at some stage the appreciation of equities in the States, but not yet. This is still the phase where people are selling their currencies, buying dollars and buying US equities. When will we know that the explosive phase is starting? Well, I would argue when we start closing above 99.83 and eventually 151. That will be when the explosion starts happening. You start going percentage points per week, which is dangerous, and I'm sure neither the Fed, the Treasury, or anybody else wants, but that is probably what they're going to get. If we look at a daily basis, I think we are now we can negate anything that happened here. It held the support that I keep on saying, this thick line 96.50. It just couldn't break there. What a great level to pick them up, and boom. To me, here we are, 99.80. At some stage we break 99.80 and then we are off to the races. It's going to be, I think volatility in FX is definitely picking up. And to me that is going to be any kind of retracement here to 98.33. I'm going to be a buyer of dollars with both hands of call options. I wanted to show you the bigger picture in the euro. This is where we've been for the past year. I think we are breaking out. We've broken out, and we might hang around for a couple of months around here. This is a monthly chart, but I think we're going down here. I think we're going down to new lows. I think we're going to break the buck, and that is how far I think things can go. If we look at the shorter term, this is a complete rejection of the 200-day moving average. Can it bounce back up to 109, 110? Yes, but I think it's looking very bad for the euro. I think now that we've taken out the previous low around 108.50, we're going to get bounces to it, but those are huge sells. Is the market oversold here? Yes, but I think that this is the major development of the past couple of weeks, that people are just abandoning the euro. They see there is no point in holding it, and it can now go a long way. Remember that monthly chart. That monthly chart basically says it breaks the buck. Well, I think gold is stuck, unfortunately, between the strong dollar and the weak yields in the bonds. It is, I think, going nowhere. It's going to be pulled in one direction, then it's going to be pulled in the other. I just can't see gold being a better alternative to risk. Yes, some people are abandoning, are buying gold in terms of safety, but I just don't see it. If it goes up, it's going to crawl up this trend line. We can even, you can see that it's, the weekly Bollingers are holding it beautifully. So if it goes up 0.5%, 1%, and then comes back. To me, we are not in a risk-off position. To me, allocating money to gold is nowhere near as good as allocating money to US equities at the moment. Well, if we look at equities from every time frame, it's bullish. The market just retraces very slightly. This is 195 minutes, which breaks the day into two. Every moving average is pointing up. Every time it gets to oversold levels, the bounce is ferocious. I.e., it's one of those markets that on any dip you buy calls and you leave them alone. If we then look at the daily chart, you can see that how the market holds every level that it should hold. This is boring to say, but the multiple expansion keeps on going on, and more money gets fueled into the market. We really don't have any resistance until 3400 in the next couple of days, and we have a huge amount of support now developing just around the 33 to 3320 level. That is going to be very hard to break. The one point of concern is that we're not overbought on the weeklies. We still have room to above 3400. but we are very, very overbought on the monthlies. And you do know that every time, I told you here that we'd get back to it, we did. I'm telling you now that at some stage over the next 30 days or so, we'll trade 33.20. But that's going to be probably another great opportunity to buy. In every time frame we look, SPX is a wonderful buy the dip kind of market, and it's led by Nasdaq. There's no doubt about it. Nasdaq keeps on leading. Even on the hourlies, there's nothing of any concern. Every time the market comes down, it is bought and it closes at the highs of the week. This is basically the definition of a bull market until it breaks this line here, which is around the 9500 level. I have no concerns even from a daily basis, and then all it's going to do is come back to 9300. A supported market. The spreads are not what is driving this market in terms of intercountry spreads. I think this is people just piling into dollars and putting those dollars into to work in the US equity market. If we look at European equities, we see absolutely the same thing. We can actually take out the retracements because there aren't going to be any. It basically is pushing up to 14,000 now. This is a long-term trend line. DAX, that's where it's going. If we have a look at the stocks, we will see how we are crawling up this long fork. It's bullish without any kind of a doubt. To me, the long-term targets in the stocks are here around 4,300 to 4,500, and that still will be below where they were in 2007. So it's hardly a huge move, but I think the US is the leader, and you probably want to be buying US more than anything else. EM at the moment, I think, is going to be stuck. I think it's going to be stuck between this 4160 level and this 4504 level. I think it's going to be very hard for EM to break 4504, and it is much better to be buying US equities now rather than EM or anything else. Simply because, as I've told you, I think people are buying dollars to buy US equities, and that they see as safety. But in the medium term, I think these markets will outperform because the coronavirus will be beaten, and when it is, we will see a big spike in EM. When will it happen? I don't know, but I know what will prompt it: a solid break on a monthly basis of 4504, and then you probably have a 10-15% run. Yes, on to the biases, and the only real change is this one. 99.80 first stop in DXY, and the fact that the dollar has turned, and therefore it argues that we will probably see a 14,000 on deck for European equities for the DAX. The DAX is being basically pulled up just by the weakness of the euro, and basically needs to go higher to stand still. But to me, you still don't buy European equities. You do not prefer them over US equities. US equities is where all the action is. It's the ones that are bought every time they dip even 0.5%. The support is around the 33.50, then the 33.20 area. I know we will see the 33.20 area, and I will buy with both hands. But to me, you still buy calls, you stay long calls, you have call spreads, you do any kind of bullish strategy, because we have not seen the top. 3400, 3420 next week I fully expect to see, and that isn't even the top. Do not try to pick the top, it's just not worth it. It's, this risk on phase will probably go on for much, much longer than we can possibly expect. And that is all I have to say. EM, until it has a monthly close above that 45.04, I'm in the accumulation mode at lower levels every time it dips, but that's about it. As long as these market here keep on propping up the equities and saying that nothing is changing, nothing is changing, nothing is changing, you will see a continued multiple expansion until everyone capitulates. Thank you very much indeed, and tweet you on Monday.